You know, when a business partnership ends, it's easy to picture total chaos, right? But the truth is, the final chapter is actually a highly structured, legally defined process. It's not always about failure. It's about an orderly and, frankly, surprisingly rigid unwinding. So let's pull back the curtain and see how it's really done.
So what really happens with all the money? You know, the assets, the debts, who gets paid first? And what if there isn't enough cash to cover everything? That's the big question we're going to unpack today. We'll go from the legal stuff that kicks it all off right down to the final payouts.
Okay, so here's our game plan. We'll start with why firms dissolve. Then we'll hit a really crucial distinction, walk through the actual accounting, tackle what happens when someone's insolvent, that's a tricky one, and finally, see how the partners get their money back.
All right, first things first, the beginning of the end. A firm doesn't just, stop. It's not random. It's always kicked off by very specific, legally defined events that officially close the doors.
And these triggers can be all over the map. I mean, it could be something totally normal, like a project is finished, or the partnership's agreed upon time is just up. But yeah, it can also be way more serious, like a partner passes away, the business itself becomes illegal, or a court actually orders the whole thing to shut down. The big takeaway here is that dissolution isn't always about failure. It's a formal process for a ton of different scenarios.
Okay, now before we dive into the numbers, we have got to get one thing straight. There's a huge, huge difference between the dissolution of a partnership and the dissolution of a partnership firm. They sound almost the same, right? But they are worlds apart, and you absolutely need to know the difference.
So here's the best way to think about it. A dissolution of partnership, that's like just changing roommates. The apartment's still there, the rent's still due, but someone new moves in and someone old moves out. The business itself keeps on running. But a dissolution of the firm, and that's what we're talking about today, that's like selling the entire building. The whole thing stops. Everything gets sold and the books are closed forever.
All right, so the firm is officially dissolving. Now what? How do you actually close the books? Well, just imagine you're methodically packing up a house you shared with friends. You got to sell all the furniture, use that cash to pay the final electricity bill and any other debts, and then you figure out how to split what's left between everyone.
The main tool for this job is something called a Realisation Account. Think of it like a temporary command center or a final tally sheet for the whole process. All the company's stuff, its assets and its debts, get moved into this one account. As you sell things off and pay your bills, every single rupee flows through here. And at the very end, this account tells you the final score, whether you made a profit or a loss on the whole shutdown.
And listen, this order of payments, it is not a suggestion. It's the law. And there's a really clear hierarchy. Look at this. Outsiders, the third-party creditors, they always get paid first. Before any partner gets a single rupee back from a loan they made to the firm or from their initial investment, every single outside bill has to be paid. The law is designed to protect outsiders before the insiders. Only after all that, if there's anything left, do you get to the profit.
Okay, let's put some real numbers to this. So, imagine a firm. On paper, their assets are worth 13 lakh rupees. They go through the process, sell some things, a partner takes over some other stuff, and they end up with 12 lakh 10,000 in cash. On the debt side, they owed 3 lakh 20,000, but they managed to settle it for a bit less, 3 lakh 4,000. Plus, there were about 6,000 in expenses just to handle the shutdown. So, after all that shuffling, did they come out ahead or did they take a loss?
They ended up with a loss, 80,000 rupees in the red. And this right here is such a critical point. Even when you think you're doing okay selling everything off, the final math can still show a loss, a shortfall. And that loss, it has to be covered by the partners. Which brings up a really big question. What happens if one of them just can't pay their share?
Yeah, that exact situation is where things can get super complicated. When a partner is personally bankrupt, insolvent, and they can't pay their portion of the firm's loss, a very famous old legal rule comes into play.
It's known as the Garner versus Murray rule, and it's a total game changer. I mean, think about it. Normally, any loss is shared based on whatever your profit-sharing ratio is. But a loss that happens because a partner is insolvent? Nope. The rules totally flip. That specific loss gets shared based on the capital the other partners have in the business. All of a sudden, the risk just shifted.
This little table really breaks it down. A normal loss? Everybody shares the pain according to the profit-sharing deal. Simple enough. But when an insolvent partner leaves a hole, the entire burden falls on the partners who are still solvent, and it's divided up based on who has more skin in the game. In other words, who has more capital invested.
Okay, we're almost there. One last piece of the puzzle. In the real world, right, you don't just sell everything in one day and get a giant pile of cash. It doesn't work like that. The money trickles in, gradually, what they call piecemeal. So the question is, how do you fairly pay out the partners as the money comes in, without having to wait until every last thing is sold?
Well, one way is called the maximum loss method, and it's exactly what it sounds like, super conservative. Basically, every time a chunk of cash comes in, you pretend it's the last bit of money you're ever going to see. You assume all the other assets are completely worthless, figure out what that gigantic loss would be, and then you only pay out what's safe to distribute even in that absolute worst-case scenario.
The other option is the highest relative capital method. This one is all about fairness and proportion. It looks at who has put in the most capital compared to their profit share, and it pays that person back first. The whole idea is to get everyone's capital accounts lined up with their profit-sharing ratio. Once everything's balanced, any more cash that comes in just gets split according to that ratio. Pretty clever.
So let's wrap this up. What are the big things to remember? First, dissolution is not a chaotic free-for-all. It's a really structured process. Second, that realization account is your main tool for tracking the whole windup. Third, there is a strict legal pecking order for who gets paid and when. And finally, and this is a big one, special rules like Garner versus Murray can totally change who has to bear the financial burden if a partner goes broke.
And that kind of leaves us with one final thought, doesn't it? When you see just how rigid the rules are for ending a partnership, all these rules about capital ratios and who gets paid first, it really makes you think. How much should these worst-case, end-of-life scenarios actually influence the choices you make on day one? When you're first setting up those profit-sharing ratios and deciding on capital contributions. It's definitely something to chew on.